So let's think about the importance of an accurate valuation. When we think about valuations, it's often key. We do this to establish a fair price for buyers and sellers. Building this trust and credibility in transactions is key. And how do we build trust and credibility? It's putting together a strategy and kind of roadmap of your thought process and being able to walk through with if you're a buyer, a seller, here is how I came, or, here's how I arrived at a valuation based on your financials that you provided, etc., rather than just giving them a number. This trust and credibility is key throughout any transaction. And another importance is ultimately you need to ensure that the price you're paying and ultimately your valuation is fair and can support a bank loan. The risk is, if you overpay for a business that can't be supported by its cash flow, you may not be able to support a loan if you take it out. So getting a clear understanding of what the business is valued is key. So what are the three major valuation methods to value a target? The first being is the discounted cash flow method, and that really is using the target's value based on its future cash flows discounted at a current rate. One that I love and use quite often is the comparable company analysis, or market comparables in short, in terms of valuations. The reason why this is very favorable and easy to understand is, one, it simply takes comparable businesses that were sold, and it gives you the framework of what a fair market price is in today's current environment. For example, if you are seeking an HVAC company that does about $3 million in revenue and operates at about a 15% margin, if you were to leverage private databases and find similar businesses that sold in that range, that could be a very reasonable and accurate valuation that you could use for a business you want to submit on. When a company or when a seller asks you questions about the business itself and what you use to arrive at it, you could simply walk through how you arrived at this. And a lot of times this works quite well with some of these small business owners who may not understand the process. They can get behind this type of valuation, and at least your approach. Another one is using an asset-based approach. So if the business is asset heavy, you could value the business simply based on the assets it owns. There are asset-based lenders, so that could be a attractive valuation approach for businesses of this nature. And the lastly is, valuing it based on the earnings. The earnings valuation approach can be a form of arriving at an EBITDA or SDE number, and then using a market multiple, such as 2 times the EBITDA, 3 times EBITDA, 4 times SDE, in order to arrive at your valuation. So what's the importance of the market comparables in transactions? Like I said, the market comparables are a benchmark for fair valuations in low and medium market transactions. They provide a quick way to compare businesses similar in nature, size and nature, in a variety of industries. So this is a very attractive methodology I often will use. So let's take a look at the landscape of how valuation multiples have changed by industry over the last few years. So this is a pretty interesting report. Obviously, this spans from transactions from 1990 all the way through to July of 2024. But it's often good to have a framework of what some of these look like. So some of the key takeaways I found from this were high valuation industries, things like information technology, 8.8 times, reflecting strong growth potential and maybe scalability. If we think about mid-tier stability, take a look at the manufacturing, 5.4 times EBITDA earnings, food and beverage, processing companies. These had similar 5 times earning multiples. On the flip side, the lower EBITDA trading multiples of industries are things like restaurants, construction, and these are often lower because there are higher operational risks, and they may have smaller or thinner margins, so they just trade at less multiples. Obviously, if the business in any of these industries becomes larger, it attracts a higher multiple. And when I say larger, it could be larger EBITDA actual dollars. So a business that has 500,000 of EBITDA will trade at a lower multiple than a business that might trade at 5 million EBITDA. This is because there's larger players involved who are willing to pay more for businesses of this nature. So to arm you with I conducted my own market research and wanted to learn what's the valuation multiples by industry in the last, let's say, 2 years. So I did a study on sale date within the last 24 months of net sales between $3 million and $15 million. I'll try to do my best to zoom in. Across all industries. So sale date was of the last 2 years. Across all industries, you'll see anywhere from agriculture to public administration, with net sales 3 to 15 million. I did remove businesses with just extremely high multiples. Like there were some that were 30 times earnings, just to not, and I did this to not skew the data in one way or another. So what did I unpack? First of all, I found 415 verified transactions. And a couple key takeaways from this chart I wanted to call out. So the MVIC, that is the sales price. It's for these transactions, 56, the means were between 3 and 4 times earnings. So when I'm often asked the question of what are typical EBITDA multiples trading at, I highlighted these 3 because the vast majority of businesses with net sales of 3 to 15 million, and give or take, if there's anywhere from 10 to 15% margins. These are the SMB type deals. They are trading from anywhere from 2.5 to 5 times earnings. So if you are thinking about valuations and saying to yourself, what should I value this business on? This is a good range. If an ask price is outside of this range, it's very likely it's not within this mean, and it's needs to be very good to be able to command a multiple of, say, 5 to 7 times earnings. And that could be due to it being quite large or having a serious growth plan. But that's typically what these means fall in line with. So what's the importance of market comparables in the transactions? These were just other stats. The first one is from Biz Buy Sell, probably the number one small business deal sourcing platform. They show a little bit of a different view. Obviously, these deals were much smaller. It was enterprise values anywhere from 500,000 to as little as 100,000. You'll notice that the multiples are trading within the 2 times earnings, which makes sense to me, given as the businesses are smaller in nature, they just will trade typically at a lower amount. So I thought this was kind of interesting, just as you kind of set the landscape, because we flip back to all of the industries with higher sales and typically higher enterprise values. The smaller ones, which we just kind of looked at, were, maybe in this chart compared to 3 to 15 million in net sales at that 3.5 to 4.5 times earnings. So when we think about, M&A and valuations in general, obviously you as the acquirer or buyer will want to purchase the target at the lowest price. And the sellers, more often than not, they want to sell their business for the maximum amount possible. So it's really, the question is, how do we get to a common middle ground where both parties agree? Because that's the key. If you're on 2 ends of the spectrum and you'll never be able to get to an agreement, likely the business is not going to actually sell or trade. There needs to be some level of agreement by both parties. So what are the critical drivers of valuations? Typically, it's historical financial performance. The market study we just looked at was historical financial data, and not so much, forecasted financial performance going forward. When we think about SMB deals, lenders will give loans. If you're using an SBA lender, they are looking at historical performance. While your go forward growth plan is going to be needed when you assume duties as a new owner, they don't lend on that. They lend based on what has the company been doing in the last, say, 3 to 5 years, and what are the challenges and some of the risks you as a new owner are pose to them giving a bank loan. On the flip side, the industry trends and competitive landscapes may also move the needle in terms of evaluation. If there are more competition and the growth trends are not looking as positive as maybe 3 or 5 years ago, that could impact the valuation. A lot of these things, and these are more operational elements, also need to be considered when you're thinking about what this business is actually worth. So these speak to, more about how we define this business valuation. Ultimately, what you pay serves as a basis for pricing in these, mergers and acquisitions. So how do we leverage multiples for precision? Um, Again, the common types of the multiples are, a enterprise value over EBITDA. You could do a price to earnings or an enterprise value over sales. Whichever common multiple method you use, it should arrive at the same sort of end result and calculation. If you use a percentage of sales and you value it on $2 million at $2 million, the same sort of valuation should be arrived if you were to use EBITDA. It's just, is it a 3 times EBITDA multiple, or is it a 20 or 30% of total revenue? However you cut it, the answer should be similar in nature. This is a good graphic. And if you have your phone, you could maybe take a picture of it. It's how you do the business valuation process, like kind of start to finish. There are business valuation providers. We have a small team who will value businesses and give you kind of benchmarks on what we think is a fair price. And that is really, we start by understanding the client needs. We want to gather the data. Ultimately, a business valuation is based on the market and the financial statements of the company. We want to normalize and adjust, if they're applicable as needed, the historical financials. So if there are one-time events, we may want to adjust those out for purposes of a fair valuation. Leveraging peer and company data across similar businesses can also be used. From there, you want to implement and select an appropriate valuation method. If you were to use the cash flow method or a market comparable method, you might want to compare both of them and then select a appropriate valuation range based on a few different approaches. Kind of from there, it's putting together some sort of report and then reviewing it and discussing it with the other party and seeing what their thoughts are on that valuation. Let me do another polling question just to see what people are thinking. In terms of like ideal business acquisitions, what kind of range of EBITDA are you targeting for your ideal business acquisition? Looks like the majority people say 500 to 2 million. We do have one who wants to know more about what's EBITDA. That's always a good one. Just keep people on their toes. Over 2 million. For those who did answer those questions, I would say in general, like the multiples of 2 million and above EBITDA ranges are going to be higher. As you get higher and higher on the EBITDA range, market multiples will increase. Additionally, entities such as private equity will start to get involved on EBITDA's, 2, 3, 4 million in range, just because they can be used as platform acquisitions, et cetera. So just things to kind of keep in mind. The 500 to call it 1.5 million of EBITDA is really that benchmark for those SBA type deals. So that's kind of food for thought as you think about the various segments of the M&A market. Just keep that in mind. Yeah, so it looks like most of the audience today is in that SMB SBA type deal size. So appreciate your contribution. So this again kind of summarizes how we think about it. Understanding, what is being, valued, what kind of methods we're going to use, what are the adjustments. Adjustments could be financial adjustments. So if there's one-time events, there could be operational adjustments. If the business is expected to have significant growth because of a new contract win, that could be helpful. Once you do put together, a typical valuation, having that discussion is going to be critical, because if your seller is, not on board, or if they have questions, understanding how you can come together and agree on it is going to be key. Yeah, so I'm actually going to pause, and I'm going to take a couple questions just so we can see what people are thinking. So someone asked, in terms of the market study. So I have a subscription to Deal Stats. It's a relatively cheap database. This is where that was generated. The Deal Stats website uses verified broker transactions who submit the data, anonymized, of course. So that's where these came from. It's typically like an annual subscription I pay for. It's quite nice in that you can see industries, etc. So I highly recommend it. There was another one. One more question on EBITDA and SDE, and then we'll kind of continue on the presentation. So someone asked, what is the difference between EBITDA and SDE? And do SIMs typically offer both of these numbers? Every SIM can be completely different, so there's no guarantee of what you'll see. There is no standard format. I would say for SMB deals, typically they're going to show an SDE number. SDE is seller discretionary earnings. Seller discretionary earnings is EBITDA plus owner compensation. So if you know how to arrive at EBITDA, earnings before interest, taxes, depreciation, and amortization, if you add the owner's compensation, so salary and benefits, that is SDE. And the easiest way to think about this is if we look at these two charts side by side, the EBITDA number, since it's not going to include an add back for, let's say, $200,000 of owner compensation, your EBITDA number is actually going to be smaller. Or no, your EBITDA number is actually going to be larger, therefore, commanding a higher market multiple, which is why it's trading at 3x earnings, etc. The SDE is going to have a smaller market multiple because it's going to be actually higher. So yeah, let me correct that. So your EBITDA excludes owner compensation add backs. So if your EBITDA was $1 million, the business would be trading at about $3 million total. If the business had $1 million of EBITDA and $200,000 of owner's compensation, your SDE would be 1.2 million. Therefore, your multiples of SDE is actually going to be lower because you're including the owner compensation. At the end of the day, both multiples will probably arrive at somewhere around $3 million, but that's why businesses of the exact, the same exact business, the multiples for SDE are going to be lower than EBITDA. So that's kind of the point of the differences. So hopefully that helps. So let's, if you think about avoidable mistakes, you want to avoid over-reliance on a single valuation method. Typically, if you use a few different ones, you can analyze those results and really understand what is a fair average? What does that look like? And how can I best explain this to the sellers and the seller's representation for them to get on board? Other things, if you ignore industry trends and other factors such as declines of revenue or one-time, customer loss, etc., you may be overvaluing the business, and that could lead to serious risk. Failing to adjust for one-time expenses and non-recurring items, those could have impacts to your EBITDA. And ultimately, if that number is incorrect, you might be valuing the business too high or too low. So keep that in mind. And if you're having trouble understanding, one-time expenses or non-recurring items, work with someone like a financial diligence provider to better understand these components. What are key insights for an effective valuation? Staying updated on industry changes to refine valuations. I know there's plenty of market studies and market reports that are published, I think almost on a quarterly basis. Keeping up to date with industries that you could see yourself buying into is going to be very important. There's a lot of regulatory changes that could happen in service type businesses that require licensing. So just staying updated and refining your criteria and knowledge around the market you want to be in is often ways you can build trust with these current business owners, and it can lead to better valuations and purchase prices. These are some advanced valuation techniques. The one that's going to be most applicable is something I like to call a scenario analysis. And this is more speaking to kind of like pro forma analysis. I do scenario analysis on all my deals, and it will look at doing those projections going forward. So one of my scenarios will be, let's say there's a decline in revenue of 15% in the first year as a new owner, like myself, would take over a business. What does that look like? So basically, Your analysis would be adding in that 15% decline across the board, and then understanding what profitability looks like, and if you can support those business loans. So that's really what it looks like. Another scenario could be if revenue stays the same next year, what does my income statement look like on a recasted basis? And recasted is really just adding in your new loan amount and other changes you plan to make. What does your income statement look like in the next 12 or 24 months? Lastly, it's like a best case scenario analysis could be, a 10 or 15% growth in that first year. What does your new recasted income statement look like? So those are kind of the scenario analysis I like to do on all my deals. One, it enables you to find potential operational synergies. And two, it shows you proof that you can support your new bank loan that you likely will need to take on to actually buy this business.